Okay, today I'm going to look at the idea behind this thing about giving up some of your pension to get an extra lump sum. You can give up to about 25% of your benefits and gain a much bigger lump sum. Now, whereas with other aspects of the pension scheme, I am generally comfortable discussing them because they're mainly about saying, yes, you can do this, or no, you can't do that. The option to swap or give up some of the annual pension to get a larger lump sum is one that takes me outside of my comfort zone. Very simply, I am not a financial advisor, and there may be stuff in here that I completely overlook. If I do and you know, please comment and let me know. However, it's a discussion that I've been part of regularly and observed for well over 10 years now on various forums, and it all appears to come down to what your personal circumstances are and what you intend to do with the money. Some are going to travel the world and spend their lives moving on and going around. Some, instead, are going to buy a motorhome, travel a little bit closer to home, holiday where and when they like. Some are going to pay off the mortgage, get rid of the debt. Some will put in a new kitchen or build an extension. Now, my gut feeling has always been to get rid of debt. To clear debt as quickly as possible. And what I want to do is put that to one side for the moment and just look at the maths. Now, all of these things that people would do with the money, they're all life-changing, life-enhancing choices. And of course, the sooner they're done, the longer you have to enjoy them. But is swapping the annual pension for a one-off lump sum the best way of achieving this? What if, instead, you took out a loan for the money you need and then used the pension to pay off that loan over many years? Now, I started to look at this with a very sceptical opinion as to whether it would be a good idea or not. As I say, my gut instinct has always been to pay off debts and not have debts. But with inflation having jumped recently, and with long-term fixed-rate mortgages still available, I decided to do what I always do when I'm not sure. And as I go back to the maths, I crack out a spreadsheet or two and see what the actual numbers tell me. And before I start looking at the main question as to whether it's a good idea or not, let me just recap the basics of swapping the pension for a lump sum. The big question, how much do you get? Well, for every £1 of your annual pension that you give up, you get given £12. Now, one thing I find very interesting about this is that there's no consideration given to your age. You can retire early at 55 or you can retire late up to 75. I mean, after all, if you're going young, then you actually could be giving up a lot more, many more years of your pension compared to if you're going old, when I'm afraid you are going to have less years of pension. So if you're going to live for, say, only 5 more years, then getting 12 times the value up front is a good idea. But I am digressing. Let me get back to the topic of today's video, considering whether paying off a loan or a mortgage with that one-off lump sum is better than keeping the pension and then paying it off bit by bit with that pension. So should you take that upfront lump sum and pay off the mortgage, or all in one go? Or should you keep it and pay it off bit by bit? And this is where it gets tricky. I mean, if I had £12,000 sitting in a bank account and I had a mortgage of £12,000, then it is simple. On the one hand, I have a bank account paying me 1% interest against a mortgage charging me 4% interest. Using the money I have to pay what I owe makes perfect sense. But that is not what we have with the pension. What we have is a promise to pay for life an amount of money. And it's this promise we are giving up to get that one-off lump sum. So I guess the question I'm really asking is, am I selling the goose that lays the golden egg to get that one-off lump sum? And I'm doing it to get that debt off my back. And if I'm selling the goose, am I getting a fair price for it? So to the maths. Let's actually look at the numbers involved, and let's start with how much you get paid for the goose. I mean for the pension. For every £1 that you give up, you get given £12. So I'm going to look at a mortgage or a loan scenario. So I'm going to do this in thousands. Giving up £1,000 gets you £12,000 of tax-free cash. Now, tax is important. Your pension is taxable income, whereas the lump sum is tax-free. So we will need to include that in our calculations. At the basic rate of tax of 20%, that means £1,000 of pension would actually be worth £800 in our pockets. At the very simplest level, we can divide 12,000 by 800 to see that it is actually worth 15 times as much and not just 12 times. The difference being that the tax-free nature of the lump sum versus the 20% tax rate that's applied to pensionable income. But is that 12,000 really 12,000? Remember, in this video I am looking at using it to pay off a mortgage. And so it is worth more than 12,000 because if I pay it off, then I no longer have to pay the bank interest on the loan. So just how much is that £12,000 lump sum worth? Of course, it totally depends on how much interest your mortgage is charging you. The higher the interest rate, the more the mortgage will cost, and therefore the more the £12,000 lump sum would be worth. Now, this is an area we can look into with some certainty, thanks to banks still offering fixed term mortgage rates. Indeed, I went on today in May 2022 and did a quick search for longer term fixed rate deals. Longer term because I know the basic maths says that the pension will take about 15 years to make up the lump sum figure. And I found a few deals for 15 years and some for longer. This is a typical one. So how much does it cost? Being a fixed rate, that monthly cost of £92 is never going to change over the 15 years. And 15 years by 180 months is the total cost. So £16,560. We have an answer. The £12,000 lump sum is worth £16,560 if we used it to pay off the mortgage or a loan instead of spending 15 years paying it off bit by bit. So this is our target figure. If we don't give up the pension, we don't sell the goose, how long will it be before those eggs have paid us £16,560? How long? Well, we know that the pension we gave up was worth £800 after tax. So can't we just work out how many 800s it takes us to get to 16,560? That would take roughly 21 years. Seems simple. But this is wrong. It makes a fundamental mistake, and one I think people make regularly when they're looking at this comparison. It's wrong because it ignores inflation. The pension that was given up in the first year was worth £800. But all those that come after it will have been increased by inflation. So how do we account for inflation? And this is a problem. We just don't know how much inflation will be in the future. The government tell us that they're aiming for 2% a year. But already in 2022, we are seeing figures in double digits, 10%, and we're not certain it's going to stop there. If we take this year as being 10%, which is where we are roughly, what does that mean we would have got from the pension if it hadn't been swapped for that lump sum? Well, it'd be 10% more, £880. That means we're going to get to our target of 16,000 sooner. And then what about the year after? Well, let's go back to our target of inflation being just 2%. After 2 years, we're getting close to having nearly £100 more. And it will keep getting larger and larger. Indeed, in this case, inflation is your friend. The higher the inflation is, the sooner you will have reached that 16,560 target. In fact, after 20 years of inflation at 2%, the pension would have increased from £800 after tax to £1,081. Now, let me just put aside my golden eggs and the goose and everything and get back to where I'm feeling more comfortable, which is into a spreadsheet. Now, inflation is unlikely to be constant, but to make it easier, that is what this sheet does. And I've put a link at the bottom so you can go and have a play for it with yourself. We started with the idea that it took us 21 years to be the payback time if we were £800 a year, but we ignored inflation. At just 2%, that's this first column, it would actually take just over 18 years for you to get more by not giving up the pension compared to servicing a mortgage with that pension money instead. And if we were to have more inflation every year, say inflation at 8%, then we would have paid more through the pension than we saved on the mortgage in 14 years. Let that sink in. That's actually less than the 15-year mortgage term that we were comparing it to. And here's the important point. That's just to break even with how much the mortgage has cost. From now on, you carry on getting that pension every year for the rest of your life. That's the problem. We don't know how much longer you're going to live. So what happens after? After what? Well, if you sold the goose and got the lump sum, then the mortgage is paid off. The money is gone, the mortgage is gone. You saved yourself from spending £16,560. But what if you paid it off bit by bit? If you lived for another 18 years, then the mortgage is also paid off. The money from those years has gone. But if you live beyond the 18 years, then the pension keeps paying you. Well, until you die, that is. And that brings me back to one of my very first points. The lump sum that you get is 12 times the pension you give up, no matter what age you are. You could be 55, you could be 60, hell, you could be even 75. You still get just 12 times the amount of pension you give up. Now, considering that the average age is 80, that means that someone retiring at 55 would have given up 25 years worth of pension, 25 years of index-linked pension. And they could have got a loan that they would have paid off in 18, 17, 16, depending on inflation, number of years. Now, please bear in mind that I am not a financial advisor, and I do encourage you to seek one out if you are considering taking the larger lump sum. My personal opinion and points to account for, my summary then, are, number one, always do the maths. Your dreams and desires probably can't be factored in, but you can get the figures worked out so that you can make an informed decision. Secondly, some things we just cannot tell at the time. Your life expectancy, how much you're going to live is one of them. I plan to live forever, but I know that's not real. And if I took out my 12 times lump sum and I died tomorrow, then yes, my estate, I will pass on more money to in my will than if I'd not taken the money. But we can't judge as well. Maybe some people can. I have talked to some teachers who have unfortunately had to make that decision. They've been told that their life expectancy is a lot shorter, and therefore clearly taking a 12 times lump sum rather than just living on for what they hope was a few years. But leave that for another minute. The average life expectancy in the UK at the moment is around 80. So use that if you're trying to decide how much you're actually giving up. And remember, what you're giving up to get the lump sum is a promise and not an amount. And that amount will be increased by inflation every year for the rest of your life. And so it will pay itself back faster than the 15 years we see initially. And finally, consider what kind of loan you could get, particularly a fixed rate one, where there's going to be no sudden surprising increases in costs. And then consider how long it would take for your pension to service that loan instead of taking the government's offer to buy your goose. Good luck with your decisions.